if you think back just a decade, crypto was this really odd, specialized concept, right?
Oh, absolutely. Confined to online forums.
Yeah, whispered about by technologists, and it felt like a bit of an experiment. But the research you shared with us, I mean, it paints a picture of something entirely different today.
It's a fundamental shift.
We're no longer tracking a niche. We are tracking a material, global financial ecosystem that has, completely altered the landscape of money and credit in less than 10 years.
And that's the critical shift we have to understand. The stack of sources you provided isn't just about price charts and volatility. It's hard data. It's tracking a revolution.
Right.
So our mission in this deep dive is to kind of extract the signal from all that noise. We're going to focus on 3 key themes.
Okay.
First, the just staggering scale of global user adoption. Second, the rise of decentralized finance DeFi as a legitimate utility engine. And finally, the ongoing tension between agile FinTech and, well, the slower-moving machinery of traditional finance or TradFi.
And when you say scale, we really have to grasp how quickly the world crossed this massive psychological threshold. We're talking about going from 0 to hundreds of millions of people.
In a multi-trillion-dollar market.
Exactly.
Yeah.
Okay, let's unpack this growth, starting with the numbers that just jump off the page. I want to start with the user growth metrics, because they redefine the whole conversation. Looking at the data for 2024, the acceleration is, it's exponential.
It really is.
By the end of 2024, the sources indicate there were approximately, 659 million global crypto owners.
659 million. And that's a huge leap from roughly 298 million at the start of that year.
So more than double. In 12 months. That kind of growth is almost unheard of.
It's the definition of a mainstreaming event. This means crypto ownership now represents about 6.8% of the entire world population.
Wow.
Which is up from just about 3% back in 2018. And if we look at where the value is stored, the total market cap, it tells a story of incredible expansion, but also one that's deeply tied to that cyclical volatility we all know.
And the journey has been anything but smooth, right? After that meteoric rise, we saw that painful collapse. So why should we trust this recent peak after the brutality of the last cycle?
That's the crucial question. So the total market cap climbed from roughly $500 billion in 2015 to over $2.3 trillion by early 2022.
And then the crash.
The brutal bear market of 2022, which plunged that value down to about $0.8 trillion. But what's so profoundly different this time is the rebound. The market came back so much stronger, peaking near $3.9 trillion by late 2024.
So we didn't just regain the value. We broke the previous ceiling and set new highs. What does that signify?
It shows resilience, yes, but more importantly, it shows a fundamental structural change in who is participating. That $3.9 trillion peak, it was driven by 2 engines.
Okay, what were they?
Continued grassroots retail adoption, which we'll get to, and the new institutional on-ramps like the spot Bitcoin and Ethereum ETFs.
Right, the ETFs were a game changer.
A total game changer. It means that unlike the 2022 peak, this latest surge was underpinned by regulated traditional financial products, which just drastically changes the narrative around stability and acceptance.
And crucially, that grassroots adoption isn't coming primarily from Silicon Valley or, the established wealthy markets. Yeah. The Chainalysis reports you shared highlight a huge shift.
Absolutely. This is where the story gets really fascinating. Emerging markets, specifically India, Nigeria, and Vietnam, they are leading grassroots adoption on a per capita basis.
So they're dominating the top of the index.
So they are. And this is proof of robust real-world demand in Asia and Africa. It's not just tech enthusiasm.
So what's driving this massive user base outside of North America and Europe? Is it just speculation?
Far from it. This is driven by necessity, by utility. Think about places with high double-digit inflation, like Argentina.
Which also has high ownership rates.
Exactly. Or nations where the local currency is incredibly volatile. People there use crypto, specifically stablecoins, as a necessary store of value.
Or for remittances.
Bypassing those exorbitant traditional banking fees. They aren't betting on the price going up. They are seeking financial safety. And we also see major adoption in places like the UAE with about 31% ownership, which shows both forces are at play.
That necessity-driven demand brings us perfectly to the second core movement, the explosive growth of utility, particularly in decentralized finance.
DeFi.
Right, DeFi. The infrastructure for lending, trading, all without needing a bank as the middleman.
Yes, and DeFi has really cemented itself as the fastest growing and most active segment of Web3. It provides the utility layer for those 659 million users we just talked about.
And it also saw that downturn in 2022.
It did, but the recovery and the structural growth in 2023 and 2024 have just been massive.
So how do we measure that growth beyond just the market price?
We quantify it primarily using a metric called total value locked, or TVL. This basically represents a total capital that's locked within various DeFi protocols, serving as collateral for loans or liquidity for exchanges. It's a measure of capital commitment and really trust in the code itself.
And what does the TVO tell us about the recovery?
It tells us the confidence is largely back. TVL roughly doubled through 2024, reaching a massive $214 billion by the end of the year.
$214 billion.
Which is about 80% of its all-time peak. And considering the reputational damage the sector suffered in 2022, a near full recovery of capital in just 2 years it's remarkable.
That's a huge figure, $214 billion. But if we put that into the context of global traditional finance, which is in the hundreds of trillions, are we overstating things? Is this utility still tiny in the grand scheme?
That's a critical perspective to maintain. And in absolute terms, yes, it's tiny compared to the balance sheet of a single megabank.
Okay.
But what we're focusing on here is the growth trajectory and the daily usage metrics. While Ethereum is still dominant, holding about 59% of that TVL, we're seeing new chains like Solana and Base just rapidly gaining ground.
So it's diversifying. The infrastructure is maturing.
Exactly.
And that daily usage is the true indicator of utility, isn't it? It's not just about the locked capital.
Precisely. By the fourth quarter of 2024, the sources note there were approximately 7 million daily wallets using DeFi services.
7 million.
That activity makes DeFi the single largest category of blockchain apps, capturing about 32% of total usage. So what here is that the growth isn't just speculation. The bulk of this activity is in tangible services, decentralized exchanges, lending, and crucially, stablecoin services.
Which brings us right back to the point about emerging markets. These services are basically replacing the functions of traditional banking, where those institutions are failing or just aren't accessible.
You've got it. This makes DeFi a primary solution, not some secondary experiment. Analysts project that global DeFi users might reach nearly 23 million by 2028, and the sector's revenue, already at $26.2 billion in 2024, is projected to grow at a nearly 47% CAGR through 2032.
A 47% compound annual growth rate.
It's huge. This solidifies the idea that blockchain is becoming a foundational new infrastructure for finance globally.
So we have hundreds of millions of users, a multi-hundred billion-dollar utility engine, and much of it is operating outside the traditional banking system. Now, let's shift focus. How are the giants of TradFi reacting to this transformation happening right alongside them?
Well, the sources outline a classic two-speed integration model. On one side, you have the FinTech leadership.
The agile firms.
Exactly. Think Revolut, Robinhood, PayPal. They're designed for disruption. They've aggressively integrated crypto trading, custody, and tokenized payments right into their core offerings.
They're just built differently, aren't they? Their tech stacks let them adapt quickly without the massive overhaul that a traditional bank would need.
That's their competitive advantage. They capitalize on lighter regulatory oversight and their modern tech architecture. Their open APIs and agile development have made tokenization pretty much routine for their user base. For them, offering crypto is just another product feature.
Okay, so contrast that with the other side. TradFi caution. What's holding back the global titans like JP Morgan or Bank of America?
Their constraints are twofold: technical and regulatory. Technically, they are weighed down by decades of what we call technical debt.
Legacy IT systems.
Legacy systems that don't talk to each other and certainly weren't built for programmable, decentralized assets. Integrating blockchain into their core ledgers is an immense multi-billion-dollar headache.
And on the regulatory side?
They face these strict, established compliance rules, KYC, AML, which are incredibly difficult to map onto pseudonymous wallets and protocols. They cite major concerns over fraud and volatility. So, a lot of their internal crypto projects are still just at the pilot stage.
So they're cautious.
Very, because failure for them carries systemic risk and huge regulatory penalties.
It sounds like a lot of strategic talking while the fintech firms are just out there capturing market share. But the sources also highlight some undeniable signs that this is changing, that the convergence is happening.
Yes, the sheer scale of the opportunity and the threat of being left behind has forced their hand. The most powerful sign is institutional adoption. 5 years ago, BlackRock wouldn't touch crypto.
And now,
Today, they are one of the biggest holders of the new spot Bitcoin and Ethereum ETFs. This is a massive endorsement.
and the blurring of lines is getting intense, especially with tokenization. This feels like the ultimate bridge between TradFi and DeFi.
It absolutely is the game changer. Tokenization is just the process of representing real-world assets like, say, U.S. Treasury bonds as digital tokens on a blockchain.
It's more than just a digital receipt, though.
Oh, much more. It means these traditional multi-trillion-dollar instruments can now exist on a programmable infrastructure. They gain instant settlement, 204/7 trading, fractional ownership,
Hmm.
all the advantages of blockchain.
So TradFi is starting to use the technology to improve its own systems.
They are. We even see cautious banks like HSBC partnering with firms like Medico for crypto custody, signaling they have to be ready to service client demand.
And the regulators are basically creating the on-ramps the big banks need to participate safely.
Exactly. The final push comes from formalized regulatory frameworks. In Europe, you have MiCA. Globally, we have impending SEC rules that are starting to lay the groundwork. So while fintech's embrace still far outstrips TradFi's caution, the pivot from skepticism to participation is accelerating across the board. So if we connect all these threads, the 659 million users, the $214 billion utility engine, the institutional convergence, the market is quickly moving beyond that early adopter phase.
And that transformation creates a critical need for a new kind of professional. It's no longer enough just to build the tech, someone has to explain it. The sources identify a critical need for knowledgeable advocates, or what they call Web3 ambassadors. This is where you, the listener, come in.
The need is enormous, especially as the technology spreads into new markets where financial literacy around digital assets is still developing. This isn't a side job, it's a foundational role.
The sources detail three core roles for these ambassadors. First, they act as the educator and connector. They don't just lecture. They translate complicated concepts into practical, useful terms.
This could be anything from running a local meetup on how to use a decentralized exchange to helping a small business navigate stablecoin payments. They produce the tutorials, the guides. They make the technology accessible and safe for new users.
And second, they are the vital community builders. Organic adoption doesn't just happen. Ambassadors foster vibrant communities around specific projects, acting as the liaison between users and developers.
This grassroots support is absolutely vital for sustained growth. They make sure the technology is built for the users, not just for the developers.
And crucially, the third role is a direct financial opportunity. This is not just volunteer work. Ambassadors are often rewarded through commissions, airdrops, or token incentives. By driving new users, they can earn passive income.
It creates a clear pathway to position yourself as a thought leader and gain real influence. By focusing on education and community, these ambassadors are instrumental in accelerating that TradFi-DeFi convergence and shaping the future of finance.
What an incredible journey. Let's just recap the scale we've established. Hundreds of millions of users, a market cap peaking near $3.9 trillion, and $214 billion locked in real DeFi utility protocols. The movement we've tracked is now an established, material, and resilient part of global finance.
So what does this all mean for you? You now have the full picture, the massive scale, the necessity-driven utility, and the institutional forces that are being forced to respond. You understand why this is no longer a concept you can just ignore.
And here is a final provocative thought for you to mull over until our next deep dive. We established that emerging economies are leading grassroots adoption out of necessity, often using stablecoins. Meanwhile, traditional wealth centers are driving institutional flows via regulated ETFs. How will these two very different engines of adoption, retail necessity, and institutional investment interact and reshape the future geography of global finance? Something to mull over until our next deep dive.